Hello, this is chapter one. Okay, so let's get started with chapter one. First thing I'm going to do is share my screen so you can see the PowerPoints along with me. There we go. Okay, so we're talking, this is kind of the introductory um, chapter. It's kind of the overview, but there's a lot of very important information in it that you really need to get a hold of. Okay, and we're going to get into that in a few minutes. But basically, starting off as kind of an overview, accounting is an information system. It measures business activity, processes data into reports, and it communicates results to decision makers. So it's kind of the language of business, as it says. The system measures business activity. It's being measured by transactions because every time you have a transaction, which is anytime you do something and get something in return, that's a transaction. And each one of those transactions is considered a business activity and it needs to be recorded. Okay, we need to keep track of these things. And at the end of certain terms, certain periods of time, such as the accounting period could be a month, could be a quarter, could be a year, we take this information, we compile it, and we put it into reports, balance sheets, income statements, things like that, which we'll talk about later also. And then from here, we have to communicate these results to decision makers, okay? Decision makers could be the owner, could be people who own stock in the company, could be partners, could be people who have let us borrow money so that they finance some of our activities. They could be decision makers. So then we have to report all of this stuff to them once we have it all compiled. So that's kind of a cycle, but that's the information system. Now, financial statements are what's done at the end of the accounting process. Okay, so the accounting process is where we record all of our business transactions, roll everything up, and then we put it all in some kind of a statement that a third party would look at and be able to understand. And that's important because that's going to determine how we format it, how we put it out there so that they can look at it and understand exactly what happened with our business. So the end product of the accounting process is financial statements, where we report on the business in monetary terms. So a few minutes ago, I mentioned decision makers. There are multiple decision makers, or there could be. Individuals could be decision makers. They're the people that own our business or manage our business. Other businesses, okay, if we have suppliers or if we supply to other companies, they might make decisions, especially if we're supplying our products to other companies. Let's say that we make microchips and we sell them to computer companies. Those companies are going to make decisions as far as, okay, this is what we want in those chips. So they're going to be making decisions. And by investing in us, they need to know this information. Okay, so we also have investors. Okay, could be stockholders, could be people who buy bonds, it could just be the bank, the local bank who's loaning us money to expand our business or whatever. Creditors are people that we owe money to. If we're manufacturing, we're going to have to buy materials to make our products. If we are just selling products, we have to buy our stock someplace. So that's where we get our inventory from. We're usually going to buy those things on credit, or a term that you'll hear a lot is on account. And those become our creditors. And then finally, taxing authorities. Depending on the type of business we're in, we're going to owe taxes. And people who, run the taxing government, anybody like that, state, local, federal, they're going to have some decision-making powers also. So those are the decision makers that we're going to have to report to. This is a good slide because it talks about the difference between financial and managerial accounting, and they're both very important. The biggest difference between financial and managerial is with financial, we're reporting what's already happened. So we've already had the transaction. Now we're going to report it. Now we're going to take that information. We're going to compile it and come up with useful data. Managerial accounting is just the opposite. It's intended for future decisions. The next course in this sequence, AC 116, is managerial accounting. And in that class, you learn to take the information that your financial accountants have given you and make future business decisions with it. That's a great course because it's really very practical, and it tells you what decisions to make in the future, and it gives you some actual empirical data to use so that you make good decisions. Also, financial accounting is intended for external decision makers. So this is information we're going to share with other people. That's why our financial statements have to be very accurate. They have to be in a special format because these are going to be seen by outside people. Whereas managerial accounting, all of that information and stuff, that is just for the internal people. That's not to be shared outside the company. These are for managers, the businesses, the owners. The types of documents we come up with for managerial accounting can be totally proprietary because we don't have to share that with anybody. That's just for us. So that's the biggest differences between financial and managerial. So let's talk about the profession a little bit. You can make a very lucrative career out of accounting. It depends on how high you want to go. At the lower levels, you have accounting clerks, which do most of the posting. They'll post the transactions and such. From there, you might go higher into a management position. From there, you might go all the way and become a certified public accountant, a CPA. CPAs are the ones that go around and do all the audits. There's also a lot of computer-based accounting now where people go in and they look for problems and they do forensics based on accounting because there is so much fraud and so much illegal activity that forensic accountants make a lot of money also. So there's a lot of different directions you can go to if accounting is your actual profession. And of course, there are some governing organizations. The first one is the FASB, the Financial Accounting Standards Board. They are a private organization that makes accounting standards. SEC is the Securities and Exchange Commission. If you have stock, if you have incorporated and you have stock, then the SEC has regulations that you must follow. If you're not incorporated, then that's not something you would have to worry about. The AICPA is the American Institute of CPAs. They are the ones that confer the CPA designation to you, and they come up with their own guidelines and standards, ethical standards too, that you have to follow in order to maintain your CPA status. Then the Institute of Management Accountants is another private organization of accountants, and it's kind of a support organization. A lot of times you come up and you have questions and things you're not sure of. That's one of the organizations you can go to try to get some answers on how things should be handled. Ethics. This is a big one because when you're in accounting, especially, you're handling money, and there are conflicts of interest that occur because of that. Investors and creditors want reliable financial information, and companies want to attract investors. So what you end up sometimes seeing, this is especially true when you do audits, is people will not accurately record their transactions and stuff to either make their company look better or make their company look worse. The worse it looks, the lower the taxes you pay. The better it looks, then the easier it might be to sell. So that is taken into consideration in accounting standards because that happens, and that's the conflict of interest that can show up. The SEC requires companies to have financial statements examined by CPA. So if you are incorporated, then you will find yourself having to be audited, and your financial statements will be looked at. And what they're looking for mostly is consistency. If you are consistently using accounting principles the same way every year, you're probably not going to get into too much trouble. If you're inconsistent, that's when they start raising their eyebrows. Recent accounting scandals have hurt investors' confidence. The United States government passed the Sarbanes-Oxley Act, which criminal offense to falsify financial records. What was happening there is there's two kinds of expenses. If you, let's say you own a manufacturing company, and if you want to go in and you want to add some new computer software that's going to increase the life of your equipment by 5 years, you can consider that a capital improvement and add that to the value of the asset. But if you go in and just do general maintenance on it to keep it where it is so that it's just running well, then that becomes an expense. Those two are treated very differently. Assets, of course, increases your assets, makes your company look better. Whereas if you increase your expenses, that takes away from your net income, so it makes your company look worse. And what was happening is a company was going in and falsely recording capital gains and such where they should have been doing expenses. And that made their company look better than it really was. And they got caught. And there was big problems. So the government ended up passing the Sarbanes-Oxley Act that made it a criminal offense to falsify financial statements. Let's see. Okay, let's talk about types of business organizations. There's basically 4 of them. In this class, we're going to talk about the first 2, proprietorships and partnerships. Actually, I'm not even sure we get into partnerships. I think they started having partnerships and corporations in managerial accounting, I think, is what they're doing now. So I don't think we're going to be doing partnerships. But we will definitely talk about proprietorships. But for now, let's talk about the different types. In a proprietorship, there's one owner, okay? If there's more than one owner, then it turns into a partnership. Very different situation. If it's a corporation, then you incorporate, which we'll talk about how that happens shortly. And the stockholders are technically the owners. And in an LLC, limited liability corporation, it's the members who are the owners. Now, in a proprietorship, it is not an unlimited lifetime. What happens is if the owner passes away, then that's it. The business is considered finished. It's concluded. In a partnership, then if one of the owners passes away, then it can be passed on to the other partner. Usually what they do is they have mutual life insurance policies, one on each other, so that if one of them dies, the proceeds goes to the other one to pay off that person's share of the business, so that they own the business now. So a lot of times that's what they'll do to protect the partnership, is they'll have mutual life insurance policies with the other person as the beneficiary, so that if something happens, then there's the money to buy out the other partner. Corporations and LLCs, it is indefinite. People come and go, managers come and go, CEOs come and go, employees come and go. But in a corporation, ownership, or excuse me, the life of it is indefinite. As far as liability, and this part is interesting, in a proprietorship, the owner is personally liable. So whatever debt the organization creates, he's liable for it. He's on the hook for it. Everything basically goes in and out through him. Partners, they are also personally liable. Usually they have some kind of an agreement in place, and the agreement will state how much each partner gets as far as income and how much each one is liable for. Usually they are kind of similar. So if it's a 50-50, then the liability is 50-50. In a corporation, the stockholders are not personally liable. A corporation is almost like a separate person, a separate living, breathing thing, and it's responsible for its own liabilities and such. There's some other interesting things, though, that we'll talk about in a few minutes. As far as an LLC, the members are not personally liable either. That's part of the limited part of the LLC. A limited liability is just that. The members are not personally liable. So that's got some very interesting tax implications and liability implications. So being more specific, the proprietorship characteristics. It is a separate legal entity distinct from the owners. The life of the business is limited by the owner's choice or the owner's death. At any point in time, the owner can say, I'm closing my doors, I'm retiring, I'm going under, I can't stay open any longer. He can choose to end the business, or upon his death, that ends the business. Unlimited liability, he is liable for all the business's debts. So that's very important too. That's why a lot of even sole proprietorships incorporate, so that they're not. Owners are not responsible for corporate debts. So if they were to incorporate their business, then that would free them of that responsibility. The problem with a corporation, though, is now you have double taxation, because what happens is the corporation gets taxed, and then the corporation pays the owner an income, and then the owner gets taxed on that income. So that's the same money that he's earned being taxed twice. So that's one of the downsides of it, is taxation. Business taxation is not a separate taxable entity. Income flows directly to the owner's tax return, where he or she pays self-employment and income tax. So that's if they don't incorporate. If they don't incorporate, then whatever money the business made, that's considered their income, and they are fully taxable based on that income. Okay, it's only if they incorporate that would change, and then they would only be, because a lot of times with a corporation, the corporation might make $200,000, but the owner only takes $100,000 of it, and the rest of it goes back into the business. He's only going to be taxed on $100,000, not $200,000. Okay, so that's one of the big differences. And then there's very minimal regulation in a sole proprietorship. As long as you're paying your taxes, then generally the government isn't going to bother you. Now, how do we organize a corporation? The first thing you have to do is you have to go to the state that you're in, and you have to apply for a charter. Okay. The charter is going to have all the details and everything that you're agreeing to as far as your corporation. It's very detailed, and you have to follow all the different details in this agreement. First thing you're going to do is you're going to ask them how much stock you can have, and then you're going to sell your stock. Okay, so you're going to issue stock, and that's how you raise the capital that runs and starts up the business. Conduct business in accordance with state law and the corporation's bylaws. These are all things that you create when you're doing your actual charter application. Once stock is issued, then the corporation begins. Stockholders vote on who will serve on the board of directors. And then the board of directors will hire officers of the corporation. So sometimes you'll have just one owner, and he'll incorporate. He'll be the only stockholder. So he will still basically run the organization, but he will have the benefits of being a corporation. I used to work for a gentleman out in Syracuse at a place called Cable Express. I think now it's called CX Tech. and he started a business in his garage, and the business grew and got bigger and bigger. And what he was doing is he was going out to companies and he was buying old computer cables as companies were upgrading, and he would buy them for pennies on the dollar. Then he would test them to make sure they still worked. And then he would go out and find other companies who were about to upgrade or weren't going to upgrade but needed those older cables, and he sold them for 500-600% profit, and he made a fortune on doing that. And that's how he got started in that business. When I was there, which was 20 years ago, we were doing about $2 million a month in sales, and he was the sole owner of the corporation. So he did everything. Eventually, he did hire someone as kind of a CEO type thing to run it, so that he could go and enjoy his millions. Nicest guy, though. He cared so much about his employees. The things he used to do was phenomenal for his employees, and he still does. But that's an example of an individual who incorporated. He is the sole owner of the company, but he has incorporated. So that's an interesting way of doing it. But now he's got the protection of the corporation, and he makes all the decisions and gets all the money. So let's talk a little bit about accounting principles. We have to have rules that govern accounting, because remember, one of the key words I said was consistency. You have to uniformly and consistently apply your accounting principles. That's what's going to keep you out of trouble. If you start doing things differently this year than last year, you're going to raise eyebrows, and they're going to think that there's something wrong here, and that's going to be a problem. So we have the GAAP, which is the Generally Accepted Accounting Principles, and this is basically the principles that everybody in the United States follows. Okay, there is a different set of accounting principles for Europe, and that makes for an interesting situation when you've got a company that is worldwide, because they've got a separate set of accounting principles that they have to follow in the US than they have over in Europe. So they've got to be able to coordinate both of those. Rules govern accounting based on conceptual framework, and the goal is to provide useful information to those making investment and lending decisions. So in other words, if we're following these guidelines, these principles, then at the end of the year, our financial statements should be reliable. And that's the whole point, is that they have to be reliable and accurate financial statements, okay? So what are the accounting principles? There's the entity concept, reliability, cost, a going concern, and the monetary unit. So the entity concept basically says that a business is separate from its owners. So we have an entity, and that entity is to be viewed in a manner that it's got its own life, okay? Reliability, accounting information is accurate and free from bias. Again, we talked a little bit about ethics and such. Well, there can be no bias in our accounting principles. That's where the reliability and the accuracy comes in. Cost, assets are recorded at purchase price. There's different valuations for assets. You can have market value, you can have purchase price, manufacturer suggested retail. In order to be consistent, we have to only value assets one way, and that's what we actually paid for them. So if I paid $500 for a refrigerator, and I'm going to initially put it on the books as being worth $500 because that's what I paid for it. The MSRP might have been $600. I got it for $500. I put it on the books at that. The market value on it might have been $550 or $450. I put it on the books at 500 because that's what I paid for it. Now, let's say I found a problem later and they gave me $50 back for whatever I found a scratch and dent. Now I really only paid $450 for it. I have to go into that account and change the value of that asset because that's what I really paid for it. So that cost is a very important one. And that's how we're going to record our assets as we acquire them, is what we actually paid for them. A going concern. We have to assume that our business will continue indefinitely. We could be sitting there as the owner of a business and we could be thinking, okay, this things aren't going well, and I'm not sure if I'm going to be around by the end of the year. Well, I can't change my accounting principles and what I do in order to change that, or based on that assumption that I'm not doing very well. I have to keep my principles consistent as if I will continue indefinitely. And that's where some of that ethical stuff comes in. Yeah, I'm not doing very well. I'm going to try to sell the business because it's going to have to go to somebody else. That means as a sole proprietor, that business will end. So I'm going to change my accounting around a little bit to make it look better so I can sell it and get out of it. You can't do that. That's a violation of the accounting principles. We have to assume that our business will continue indefinitely. And then the monetary unit that we use in the United States is the US dollar. It's considered a stable unit of measure, and everything that we do will be in US dollars. This slide right here is one of the most important slides you'll ever see. It is called the accounting equation, and everything is based on this. When you hear the term accounting, a lot of times you'll hear the term double entry accounting. And what that simply means is we have an equation that we have to maintain. And that means that if we're going to keep it equal, we have to either add something to both sides or add two things to one side, a positive and a negative. So this is an actual equation that we have to maintain. And if at any point we don't equal, then we've got a problem. We've got to backtrack. We've got to find it. So here's our accounting equation. Assets equal liabilities plus owner's equity. Okay. So assets are all of our economic resources. It could be the building we're working in, could be the supplies that we use, it could be our inventory, it could be vehicles, anything that's considered an economic resource. That also includes cash. It also includes what we call receivables. Receivables are when people owe us money. We're going to receive it. So a receivable is something that we're going to get. Those are considered assets. Now, liabilities are claims to economic resources, okay? So liabilities basically is what we owe, okay? We owe somebody either money or a service or a product, but if we owe, then that's considered a liability. Owner's equity is basically whatever the owner has put into the business themselves, along usually it's cash, okay? And they put that into the business, and that is a claim to the economic resources of the business, okay? So this is very important. The accounting equation is assets equal liabilities plus owner's equity. And we're going to be using this throughout, okay? So assets, economic resources that have a future benefit. Cash, accounts receivable, that's all the people that owe us money. How many times have you gone out and you've bought something on account? Okay, on account simply means you've bought it on credit. You've received it, but you haven't paid for it. Well, now turn that around from the angle of the business, okay? I've given someone either merchandise or services, but they haven't paid me. What that means is that they owe me now, and they are considered a receivable. So I'm going to have a separate account just for them with their name on it, showing how much they owe me. Our merchandise inventory. Merchandise inventory is everything we might have for sale. If we're going to sell something, until it's sold, it is considered an asset because it's got a future benefit. We're going to make money off of it. Okay. So that's merchandise inventory. Furniture, land, all examples of assets. Now, claims to assets, liabilities. These are debts payable to outsiders. So now the tide's turned. Everything's turned now. We're going to flip it over, and now we owe somebody else. Most of the time when you see people with stock inventory, they haven't paid for all of it. It's not all paid for. They owe money on it. Car dealers, there's millions and millions of dollars worth of cars on a dealer's lot. He hasn't paid for all of those yet. He still owes. That's a debt or a liability that he owes to the manufacturer. Anything, when we get a bill for our electric, we get a bill for our utilities. These are all liabilities. Somebody works for us. Until we actually pay them their salary, that's a liability. We owe it. Okay. So you can have accounts payable, you can have bank loans, all examples of liabilities. The owner's equity is the owner's claims to the assets of the business. In a proprietorship, this is called owner's equity. Okay. When we get into corporations, it becomes capital. But for our purposes here, this is a sole proprietorship, so we're going to call it owner's equity. They're the same thing. So if you see owner's equity or you see capital, same thing, just a different term. Okay, so don't be confused by it. Now, capital or owner's equity, the way we come up with that is we take and determine their net income, and then we subtract any withdrawals that they've made. Sometimes a proprietor will just come in and he'll just take $500 out. I used to know a guy, he used to own a telecommunications company. And after a while, it got pretty big, and he was making just a ton of money to the point where he wasn't around much. He had all of his people running the business, and he would come into the accounting department and say, yeah, cut me a check for $5,000. I'm going to go down to the Bahamas for a week, or I'm going to go buy something. And they would just cut him a check for $5,000. Now, that's not income. That's considered a withdrawal. Okay. He just took and withdrew that money, and we subtract that from net income because that's where it's going to come from. And net income minus those kinds of withdrawals is what the capital account's going to equal. Okay. So that's how we come up with it. Net income, we add net income to capital, and then we subtract any withdrawals that they took because it's all coming out of capital. Now, net income, and this is important too. Net income is derived by taking all of our revenues from all of our different sources and subtracting all of our expenses. So revenues could be from the sale of goods, could be from the sale of services. Revenue can come from a lot of different places. Our expenses, that could also come from a lot of places. Expenses could be the initial cost of our inventory. It could be from the supplies we use in the office. We went out and bought a new laptop for our office to run the business and do the accounting on. So that's an expense. All of these things that are expenses, these are outlays of money on our part. Okay, these things are all considered expenses. We take revenues, we subtract expenses, that's net income. Okay. Revenue, accounts earned by delivering goods or services to customers. You can have sales revenue if you're selling merchandise, service revenue. You see that a lot. People go and work on computers and they maintain computers with service contracts. That's all revenue. Interest revenue, whatever somebody owes you money, they might also owe you interest. Or you might invest money, that's interest. And then dividend revenue. So if you have own any stocks or anything and you get dividends, that's all considered revenue. Expenses, outflows of assets or increasing liabilities in the course of delivering goods or services to customers. As I'd mentioned before, salary expense, rent. Okay, we might be renting our space where our business is. Utilities, I got to keep the lights on, I got to heat it. And then interest. If I'm borrowing money in order to run my business, I'm going to be paying interest. Those are all expenses that will come out of revenue to formulate net income. So here's a little box, and this basically is just kind of illustrating the accounting equation. So assets equal liabilities plus owner's equity. So if we put a little equal sign between assets and liabilities and a little plus sign between liabilities and owner's equity, we should be able to figure out what is in the other boxes. So 25,000 plus 43,000 equals our assets. 85,000 minus, let's see, liabilities and 54. So it'd have to be 85 minus 54 would equal liabilities. And then 102 minus 49 would equal owner's equity. So let's take a peek. 68,000, 31,000, and 53,000. So that basically illustrates our accounting equation. Okay. Right now, what I'm going to do is I'm going to end this video and we're going to start part 2. So please take a look at part 2. I'm going to stop this for now. And this is part 1 of chapter 1. And in a few seconds, I will do part 2. So stay tuned.